Anastasia, new year. A lot of people are concerned about where we are headed. How about you?
Well, there's certainly plenty of reasons for concern as we grapple with a slowdown, as we grapple with the Fed. But, coming into the year, I'm sort of looking through this with a fresh perspective and a bit of optimism. And in the first 5 trading days of the year, what gave us cause for optimism is that inflation really is seemingly easing across the board. And we're not going to call victory in this just yet. But if you think about all the different components of CPI, the goods part, for example, is starting to come down significantly. It was running at 16% year over year sometime last summer. Now that's down to 5.3% year over year. So that's a significant step down. We just saw the NFIB report that you talked about where businesses are not planning to raise prices quite as much as they have before. So that's a positive. And then the payrolls report, it was sort of a soft landing report and told us that jobs are still there, and yet at the same time, wage growth is slowing down. So you add all that together, and that bodes pretty well for the CPI report that we should get on Thursday. And in fact, consensus does expect 0% change month over month. So that's a very positive narrative, and that's really the linchpin to the markets this year. So I think that's one reason for optimism, but also the fact that we've now sort of priced in the slowdown or a shallow recession. That's become a consensus view. I think that's also a good thing.
Yeah, I think those are all good things. I guess this number on Thursday, the inflation number, the CPI on Thursday, though, that's going to be a big issue because this is a pretty fickle market. And market takes off in one direction, is feeling great about things. If that number comes in above 0%, if it comes in hotter, you could see a pretty quick turn.
I think that's right, Becky. And I mean, the point here is that we're not out of the woods yet, and this is not going it's not going to be an escape velocity market. I think this is still going to be a tug of war for the next several months, because if inflation disappoints, to your point, that's not good news. If it's if it kind of, surprises positively and the markets, try to rally, guess what? The Fed is probably going to try to talk the markets down. So the market is still going to be caught between these two forces. But as an investor, I think what you do is you recognize the overall trajectory over the next 6 months is likely to be down for inflation. And over the next 6 months, the Fed will likely have hiked the rates high enough to be above the core PCE. So, Becky, one thing that I'm looking for, come middle of this year is that the Fed funds rate will be at 5% or above that, and the core PCE will be around somewhere like 3.8%. So for the first time in months, quarters, we'll have a gap that opens up where that nominal rate will be higher than the core inflation. And that's what eventually will give the Fed the opportunity to pause, if not cut rates. And that's a positive development for the markets.
For years, the strategy of buying on dips was a pretty smart one. Last year, not the case. You could really get your head handed to you doing that. Do you feel comfortable getting back to a strategy like that if you think that this is positive overall and then you see a head fake from the markets and things run lower, maybe a 3% dip, 4%? Would you buy that?
I think you begin to think about committing to buying the dips once again, and don't do this over the next week. Do this over the next 3 to 6 months, I would say, and have a strategy in place. The reason, Becky, I say I'm a lot more comfortable saying that today is, first of all, we had a huge reset in valuations across the board. Rates went from 0 to now going to be 5%, and fixed income corrected across the curve. You had some spread widening. You had valuations in equity markets that reset that were in the 90th percentile. Now they're sort of down the middle. So these are all very positive developments. Software valuations went from 20 times, enterprise value to revenues to 5.5. So you had massive corrections in valuations that we have priced in a lot. So that's why I say, have a strategy of gradually accumulating assets on the pullback. Look, 2022 has been a reset year, and I think what people underappreciated, ourselves included, coming into the year is how long that reset is going to last. It lasted the entire year, but I do think between now and 6 months from now is where you want to take advantage of these valuations.